Well, hello everyone. It's great to visit with you again as the summer of 2022 gets underway. In mid-June, the widely followed large company S&P 500 equity index dropped into bear market territory, which we define as a peak to trough decline using closing index prices of 20% or more. As of late June, the S&P 500 bear market has gone lower than down 20%, and at this point, we don't know if the bottom has been set. Investors are digesting several market headwinds that include ongoing inflation pressures, the Federal Reserve Bank or the Fed removing liquidity by raising its overnight Fed funds interest rate, and slowing economic data, including recent weakness in housing and retail sales. The Fed is raising interest rates, hoping to slow growth to fight inflation, but not to the point of causing a recession. And it's a fine line and a difficult line that the Fed is on that's likely to play out over the next few quarters. At the same time, equity markets have pulled back, indicating that at least some of the bad news is being considered by investors, but significant uncertainty remains. Historically, bear markets are longer-term events. It takes time to make a bottom and then takes time to climb back to the previous highs. And we expect market volatility to continue before the bottom is confirmed. But we're already seeing many high-quality companies trading at what we view as very attractive valuations. In a difficult period for U.S. equity investors, there are several strategies to consider to help manage through this bear market environment. Number one, identify high-quality companies that have the ability to raise prices and build customer loyalty. We talk about this a lot, but our definition of quality includes companies with leading market share, skilled management, profitability, and cash flow during times of economic headwinds, and strong balance sheets so they can manage through their debt levels. Number two, remain diversified across the sectors, and this includes having exposure to defensive sectors like consumer staples, utilities, and healthcare, where demand for products is less exposed to those economic cycles. And then finally, consider dividend-paying stocks, especially companies that are able to raise dividends in the current environment, as we expect dividends to be a larger percentage of total return in this tough market environment. For specific recommendations on strategies, please contact your D.A. Davidson financial professional.